All right, question 51. Synthetic collateralized debt obligations, or synthetic CDOs, are backed up by which of the following? A, credit default swaps, B, leveraged bank loans, or C, corporate market bonds. So corporate market bonds, this would not be used to back up synthetic CDOs. This would just be something like a CBO, collateralized bond obligation. So we can go ahead and rule out answer C. Answer B, leveraged bank loans. If these were pooled, that would be called a CLO, which is collateralized loan obligation. And we can kind of see that loan is in that name, bond is in the CBO name. So we can go ahead and rule this out. So then from here, we've got synthetic CDOs, which are going to be backed by credit default swaps. So basically, synthetic CDO is just a pool of credit default swaps put together within the asset-backed security structure. Answer A. Question 52. When the government par curve is raised and lowered by 30 basis points, the new full prices for a callable bond are $99 and $103 respectively. So what this first part is telling us is when we raise by 30 basis points, we're going to have our bond now priced at $99. And when we lower by 30 basis points, it's going to go up to $103. If this bond currently sells for $101 on the secondary market, its effective duration is closest to. So we're going to be using our effective duration formula, which is going to be PV minus PV plus. So PV minus, this variable, is what is the value of the bond when basis points go minus, when the yield of the bond is lowered. So in this case, we're lowering by 30 basis points. So when the bond is lowered by 30 basis points, what is that new price? And then PV plus is going to be the opposite. So we'll be plugging in 103 here for the PV minus, which is given, and we're going to be plugging in 99 for PV plus, which is also given. And then so we've got our numerator covered. So this is going to be 4. And then our denominator is going to be 2 times the change in the curve. Change in the curve is also given at 30 basis points. And then we're multiplying that by the current price, which is also given at 101. So for this problem, we're given all the variables. This is really just making sure that we memorize this formula and know when to use it. So we've got 103 minus 99 divided by 2 times 0.003 for 30 basis points times 101 for the current price gives us 6.6 for our effective duration. We're just going to line up right there with answer A. Question 53. A bond was issued on January 6, 2017 at 97 as a percentage of par. The par value was $1,500. The bond is callable in whole on September 7, 2025 at 103.4. The bond can most likely be classified under which category? So we've got American callable bond, European callable bond, or Bermuda style callable bond. I'm going to pull in this little chart or cheat sheet, whatever you want to call it here, that tells us when these bonds are callable. Since that seems like the most relevant information, we're trying to determine what type of bond it is based on when it's callable. So for the question we've got, the bond is callable on September 7th, 2025 at 103.4. So on the specific day, it's callable at this price. So for American bond, American callable bonds, these are going to be continuously callable. So that wouldn't really align with what we have here. We're only allowed to call on this specific date. So we can go ahead and rule out American callable. European callable is called on a specified date. So that would align with what we have here. We have this one specific date that we can call it at. So I'm leaning towards European right now. And then for Bermuda, this can be called on multiple dates after some protection period. So it might be in this case, it's a little over 8 years or 8.5 years. Maybe the Bermuda bond might have this as a callable option, but then it might have another callable option in 6 months at the next coupon payment, and then again a year later at the next coupon payment. So Bermuda will be similar in that it has a specific date or dates that it can be called on, but it's going to have multiple, whereas a European is only going to have one. So we can go ahead and rule out Bermuda, confidently go with answer B here. Question 54. Regarding fixed income, which of these statements is least likely a negative covenant? So based on it being least likely a negative covenant, 2 of these are going to be negative covenants and one's going to be positive. As a reminder, negative covenant is something as an issuer that we are not allowed to do, whereas a positive covenant is going to be something that we must do. So negative is avoid, positive is must do to meet the terms of the bond agreement, essentially. So we've got A, negative pledges. Is this a negative covenant or a positive covenant? This is going to be a negative covenant, so we can rule that out. Negative pledges essentially means that they're not going to use collateral for this loan that they're getting for any other loan with a different bond issue. B, insure and maintain assets. Is this negative or positive? This sounds like it's leaning more towards positive. We're needing to do something or take an action, and it's not a restriction on what we must do or what we can't do. It's telling us that we need to insure and maintain our assets that are backing that loan. So this sounds like a positive covenant, so that would be our answer B. C, let's make sure we can rule this out. Restrictions on prior claims. Again, this is a negative covenant, so we can rule it out. This is essentially saying that other debt won't be prioritized over the current debt that's being issued. So we've got answer B here. Question 55. A debt instrument whose entire face value is paid in one lump sum on the maturity date is most likely called. So entire face value meaning the entire principal paid in one lump sum at the maturity date. What's that called? A, bullet bond, B, fully amortized bond, or C, partially amortized bond. So we can get rid of C and B, and that's because in a fully amortized bond and in a partially amortized bond, we're going to be paying that principal down over time with each payment. So if it's monthly or quarterly payments, some portion of that payment is going to be interest, some portion of that is going to be principal. And then we'll go with A, which is a bullet bond. And in this case, what we're doing over the life of the loan is probably just paying interest over time. And then we pay the principal back as a lump sum, as described in the question here. So we'll go with answer A here. Question 56. Which of the following statements regarding futures contracts is least likely accurate? So note that we've got least likely accurate here. So 2 of these will be accurate and 1 will not be. A, futures contracts are all cash settled contracts. This looks like it'd be our answer right off the bat since it states all are cash settled. Some are cash settled, but some will require delivery of the underlying. So I would say we could lean towards choosing A right now. Let's make sure we can rule out the others. B, futures contracts always trade on regulated markets. This is going to be ruled out since that is a correct statement. They're always going to be exchange traded and standardized. And answer C, the value of a futures contract is always derived from its underlying asset. Again, we can rule this out since that's accurate. Futures are they are a derivative and they're tied to an asset, so their value is going to be driven by that underlying. Answer A. Question 57. An investor purchased a 3-month call option by paying $1.08. The exercise price of the option is $3.32, while the underlying is priced at $4.35. The price at which the break even will occur is closest to $2.24, $4.40, or $5.43. So for our break even, this is going to be equal to exercise price plus our premium that we paid. So once we get over this, then we're going to be making money. So it's a pretty straightforward calculation here. Break even equals strike plus premium paid. We get 4.4, which will give us answer B. So we can see even though we're very well in the money here, 4.35, that hefty premium that we paid is still keeping us from technically making a profit at this point. Question 58. A synthetic long position in a riskless bond is created by combining. And in these answers here, we've got different combinations of calls and puts. So we've got long put, long underlying short call, and then B, we've got long call, long underlying short put. All these 3 different combinations. So I think the best way to solve this is to bring in our put call parity formula and talk through these variables. So we've got call plus this variable here, which is representative of the risk-free bond or the riskless bond. So it's going to be our strike price discounted back to the present value. And then that's going to be equal to the put plus the underlying, which is our S variable. So to solve this, basically, what we're going to do is I simplified this equation a little bit. So we've got the call plus the riskless bond equals put plus underlying. We're going to move the call over to this side by subtracting it from both sides. So now we have our riskless bond equal to the 3 different positions. So now we can use this to imply what will be long and short for the 3 positions for our answer. So if the value is positive, we're going to be long that position, and if it's negative, we're going to be short. So we've got a positive put, so we're going to be long the put. So if we look at these answers here, we've got long put, we have short put for B, so we can rule out that. And then for C, we also have a short position in a put, so I think we can rule out C as well. Let's make sure the others line up at first though. Then we've got plus the underlying, so the underlying is also going to be a positive value, so we're going to be long the underlying, which looks good so far with A still. And then for C, we've got negative call, so that means we're going to be short the call to make this riskless bond, which looks like we are. So we're going to go with A, long put plus long underlying plus short call. And if you think about these a little bit more in depth as well, what we're doing here is we're long the underlying, which is a bullish position, and then we're also long a put, which is bearish. Let me put my arrows in here. So we're bullish, bearish, and then if we're short a call, we're also bearish. So essentially what this position is we're long the underlying and then we're short a risk reversal trade. And so these positions basically cancel each other out because we're long on one leg and short on the other leg, and our exposure basically just becomes the risk-free rate. Answer A. Question 59. Black Oil Traders, Inc. is an American oil producing company that regularly sells oil futures to reduce the risk of fluctuating oil prices. This activity can best be described as hedging, clearing, or speculating. We know it's not clearing, since clearing was only going to be done by a clearinghouse essentially, or somebody that is the middleman for the buy and sells on the oil futures. This is an oil company, so they're not going to be in the business of clearing futures contracts. So then between hedging and speculating, the key thing we need to look at here is why are we buying and selling these oil futures contracts? So they say that they're selling in order to reduce the risk of fluctuating oil prices. So if we're looking to reduce risk, that's going to be a hedging activity. They're hedging their business, and this is typically what a business will be using futures for. They're not normally going to be speculating to try and make profit because they're making profit by producing oil. If we were speculating, then in the question it would say something about they thought oil prices were going to drop, so they were selling oil futures or something like that. So we can rule out speculating, confidently go with answer A, hedging. Question 60. Doug Beckham and AAPL's derivative manager purchased a USD 100 call option for the price of USD 11. So we've got our strike at 100 and we paid a premium of $11 in February 2019. If Beckham predicts Apple will be trading at USD 120 in February 2019, so we bought our strike for February 2019, but we think the price will be above that. The break-even price for the option is closest to. So we had a question like this earlier as well, but that break-even is going to be equal to our strike plus our premium paid, since the strike is where we start to get in the money, and then our premium paid is also going to subtract from our profit. So essentially we need the price of the underlying to be above 111 in order to break even and be at 0. And then once we're above that, that's when we're making profit. So pretty straightforward calculation. It's just going to be a 100 plus 11, which is 111. Answer B.